In America, one silent machine is creating more millionaires than startups, crypto pumps, or viral businesses. It doesn't trend on social media. It doesn't promise overnight riches, but it quietly controls trillions of dollars and shapes the financial future of the United States. That machine is the U.S. equities and ETF market. From Wall Street billionaires to everyday workers with retirement accounts, this system decides who builds long-term wealth and who gets left behind. And today, we're diving into the psychology, the power, and the hidden truths behind U.S. equities and ETFs. Because once you understand this system, you start seeing money differently. One spends hours scrolling social media, jumping from trend to trend, always chasing the next hot investment. The other barely checks the market. Once a month, they invest quietly and go back to their life. 10 years later, the second person is often wealthier. Why? Because in the United States, wealth isn't only built by working harder. It's built by owning assets that grow over time. And that's where equities and ETFs come in. Equities represent ownership in companies, the same companies that power the U.S. economy. When those companies grow, their shareholders grow. ETFs, exchange-traded funds, changed everything. They allowed everyday Americans to own pieces of hundreds of companies with a single investment. Suddenly, you didn't need to be a Wall Street insider. You just needed patience and discipline. Today, trillions of dollars sit inside U.S. equities and ETFs, retirement funds, pension funds, institutional money, and behind all of it lies a fascinating psychological game. Let's rewind. Decades ago, investing in the stock market required stockbrokers, phone calls, and significant capital. Only the wealthy had easy access. Then came index funds. Then came ETFs. And everything changed. Firms like Vanguard introduced low-cost funds designed to track the market instead of trying to beat it. This idea sounded boring at first. Why settle for average? But over time, something surprising happened. The average, consistently applied, started beating most active traders. Then, giants like BlackRock expanded the ETF universe even further. Now investors could track sectors, industries, entire economies with a single click. The result? A massive shift in how Americans built wealth. Instead of picking individual stocks, millions began investing in the broader market itself. They weren't betting on one company, they were betting on the entire U.S. economy. And historically, that bet has been powerful. One of the strongest supporters of long-term equity investing is Warren Buffett. Despite being one of the greatest stock pickers ever, he repeatedly emphasized a simple idea. Most people don't need complex strategies. They need consistency. He often highlighted how broad exposure to the U.S. market allowed everyday investors to participate in economic growth without constant trading. Why? Because the U.S. market isn't just numbers on a screen. It represents real companies, technology giants, healthcare leaders, consumer brands, infrastructure firms. When those companies expand, innovate, and generate profits, the market reflects that growth over time. But here's where psychology enters. During market booms, confidence turns into overconfidence. People believe the market will only go up. During crashes, fear takes over. People believe it will never recover. Both emotions lead to the same mistake, reacting instead of thinking long-term. The ETF structure was designed to remove some of that emotional pressure. Instead of betting everything on one company, investors spread exposure across many. Yet, even with ETFs, psychology still controls behavior. Some investors panic during downturns. Others chase performance during hype cycles. Few remain calm through both. And historically, calmness has been rewarded. So what really separates successful long-term investors from everyone else? Not intelligence, not luck, not even timing. It's behavior. U.S. equities and ETFs are deeply connected to human psychology. Markets rise and fall, but emotional reactions often amplify those movements. Fear creates selling pressure. Greed creates buying pressure. Media amplifies both. Yet institutions and long-term investors often operate differently. They focus on time horizon rather than daily noise. They understand something most people forget. Markets move in cycles, but economies evolve over decades. When you zoom out, the U.S. equities market reflects innovation, productivity, and corporate growth. ETFs simply became a vehicle allowing millions to participate in that growth. The real challenge isn't access anymore, it's mindset. Can you think long-term in a short-term world? Can you stay rational when headlines scream panic? Can you remain patient when others chase hype? These questions define outcomes more than any market prediction. Because wealth in modern America often comes from consistency, not constant action. U.S. equities and ETFs are more than financial instruments. They are mirrors of economic growth, innovation, and human behavior. Some people treat them like a casino, others treat them like a long-term ownership system. Over time, those two mindsets lead to very different results. The market will always move, news will always create noise, but disciplined thinking has quietly built more wealth than hype ever will. Understanding how equities and ETFs work isn't just about finance, it's about understanding how modern wealth is created and sustained. If you want more deep insights into crypto, finance, and wealth psychology, follow for the next lesson.